In the last 24 months or so, something incredibly strange has happened in the upper echelons of Australia's biggest billion-dollar companies.
Yeah, it really is a massive shift.
Right. They completely stopped hiring visionary, charismatic CEOs. I mean, the kind of executives who, grace magazine covers.
The ones giving the TED Talks.
Exactly. The TED Talk guys who spin these grand, sweeping narratives about the future of their industries. Those people are suddenly, well, entirely out of fashion.
Completely out.
Instead, boards of directors have started hiring, for lack of a better term, they started hiring plumbers.
Plumbers, I like that. It's very accurate.
So today, we are going to look at a tidal wave of corporate data to find out why the market is suddenly terrified and why being boring is basically the new billion-dollar mandate.
Because it is a massive structural pivot. We're looking at a period where the foundational logic of, who gets to run a major company has been completely rewritten.
And that is exactly our mission for this deep dive. Today is Sunday, May 24th, 2026. We're currently sitting in the aftermath of a massive, unprecedented reshuffling of the Australian C-suite.
Yeah, a reshuffle that really kicked off in 2025 and has just accelerated wildly through the first half of this year, 2026.
Right. And to figure out what's driving this, we have a fascinating stack of source material centered around a newly released executive search report from Byron Thomas Recruitment.
But we should probably define the scope of what we're looking at today, right? Because it really dictates the gravity of these decisions.
Yeah, definitely. Lay it out for us.
So the Byron Thomas data is not tracking nimble 50-person tech startups.
Right, not the places where a founder steps down because they want to, spend more time with their angel investments.
Exactly. The source material is strictly focused on major listed or nationally significant organizations. We're talking exclusively about businesses operating well beyond the $500 million threshold.
Oh, wow. So the big players.
The massive players, in many cases, into the tens of billions.
Which, begs the question for you, the listener. Why should you dedicate your time to this?
Right. Like, why does this matter to the average person?
Yeah. If you are prepping for a Tuesday morning team meeting or just trying to navigate your own career, why do the hiring mechanics of a $50 billion mining conglomerate matter to you?
It's a fair question.
It matters because the absolute highest level of corporate hiring acts as a perfect, unvarnished leading indicator. When a board of directors commits millions of dollars in base salary and equity to a specific human being, they aren't just filling a vacancy.
No, they're actively placing a massive bet.
Exactly. A massive bet on what they believe the macroeconomic future looks like. So if you want to know what the market fears, what investors are punishing, and where capital is flowing right now, you don't read a company's PR statements.
You definitely do not read the PR statement.
Right. You look at the specific skill set of the person they just handed the steering wheel to.
Because a C-suite appointment is essentially an admission of vulnerability. The specific type of problem solver a board chooses tells you exactly what kind of existential problem they are currently sweating over behind closed doors.
Okay, let's unpack this. Let's look at the biggest problem on the board right now. The Byron Thomas report makes it clear that the era of the disruptor is dead.
Dead and buried.
Yeah, replaced by the return of the heavy lifters. This pivot toward gritty operational discipline. And to really understand the mechanics of this, we need to start where the capital intensity is the highest.
Right, we need to talk about resources and energy.
Exactly. Let's look at BHP. They announced that Brandon Craig will officially become CEO and a director starting July 1st, 2026, taking over from Mike Henry.
And if you look at Brandon Craig's trajectory, it perfectly maps to this new demand for heavy lifters. Well, the BHP board had their pick of literally anyone in the global executive talent pool. They could have poached a theoretical strategist from a massive private equity firm or, a charismatic leader from a different industrial sector just to shake things up.
But they didn't.
They didn't. They elevated someone with deep, incredibly calloused operational credibility. Craig spent years leading BHP's America's growth strategy, and before that, he was the head of Western Australia Iron Ore.
I want to pause on that because Western Australia iron ore sounds like, just a line item on a resume.
Right, it sounds very corporate.
But in reality, it is the economic engine room of the country. I mean, we are talking about moving Earth at a scale that sort of defies human comprehension.
It really does.
You have autonomous trucks the size of houses, rail networks that stretch for hundreds of miles through the desert, and port facilities loading bulk carriers 24 hours a day. It is a logistical leviathan.
It is highly complex, incredibly dangerous, and highly profitable if and only if the operational discipline is flawless.
Right. Because the margins for error are non-existent.
Exactly. A 1% fluctuation in efficiency or safety across a network that size equates to hundreds of millions of dollars. So by elevating someone whose hands have been on those specific levers, the BHP board is broadcasting a clear mandate.
They're saying, we need someone who actually knows how the machine works.
Yes. They are prioritizing deep internal succession, and they are demanding undeniable proof of execution, especially as they pivot heavily into what the report calls future-facing commodities.
But wait, hold on. Let me push back on this a little bit.
Sure.
Because if I am an institutional investor looking at BHP, isn't an internal operational hire like Brandon Craig just an incredibly safe, almost defensive choice?
I can see why you'd think that.
Right, because we hear constantly that companies need to innovate or die.
Well,
Why wouldn't a board facing a massive global transition bring in fresh blood, someone who isn't institutionalized by the company's existing culture?
you're thinking of it like a peacetime architect.
Exactly. It feels like they're choosing a peacetime architect to just keep the lights on,
Yeah.
rather than a wartime general to conquer new territory.
What's fascinating here is that if you look under the hood of the current economic reality, the exact opposite is true.
Wait, really?
Yeah. The internal operational choice is the wartime general. A board overseeing a capital-intensive giant like BHP isn't operating in a steady-state environment. They are operating in a market where geopolitical tensions are swinging commodity prices wildly from quarter to quarter. They are facing compounding regulatory pressures regarding emissions and, environmental approvals.
About all the green energy targets.
And crucially, inflation is driving the cost of capital projects completely through the roof.
So the luxury of on-the-job training is just gone.
Completely gone. You cannot hire an external visionary who needs 18 months to understand the multi-decade life cycle of a major mining asset.
Because they don't have 18 months.
Exactly. Future-facing commodities, things like copper and nickel, which are essential for electric vehicles and global decarbonization, they require massive, long-cycle capital investment.
Meaning you're spending money now for a payoff way down the line.
Yes. You are making decisions today that won't yield a physical product for a decade. The board needs someone who intuitively understands complex approvals, massive asset integration, and fierce stakeholder pressure.
I see.
So the quote-unquote safe internal choice is actually a highly aggressive strategic posture to protect margins during a highly volatile cycle.
Okay, that makes the Woodside Energy appointment suddenly look a lot less like a coincidence and a lot more like an industry-wide panic regarding project execution.
Oh, absolutely.
Woodside appointed Liz Westcott as CEO and Managing Director on March 18th, 2026, after she had stepped up as acting CEO.
It is the exact same underlying mechanism. Another massive energy player, another deliberate elevation of deep internal operating depth.
Right.
The source material highlights this as a clear signal of the board's absolute preference for disciplined energy project delivery. And the timing here is the critical variable. Woodside is standing at a highly sensitive crossroads for large-scale energy investment.
Because they are caught right in the crosshairs of the global energy transition paradox.
Which is incredibly tricky to navigate.
Yeah, you have to somehow milk maximum efficiency and profit out of legacy fossil fuel assets while simultaneously charting a multi-billion-dollar course toward future green energy demands.
All while activists, investors, regulators, and politicians are literally breathing down your neck.
Right. You cannot navigate that paradox with a slick slide deck.
No, you can't. When a single offshore project costs billions of dollars, requires international joint ventures, and takes a decade to bring online, the singular metric that matters is operational rhythm.
Meaning, does the CEO actually know how to build the thing?
Exactly. Does the CEO understand the physical pipe, the engineering constraints, and the supply chain realities? That is what the board is buying.
And we are seeing this bleed right through the supply chain. It's not just the companies pulling the resources out of the dirt, it's the companies servicing them.
Right, the service providers.
The report points to Parramatta, the massive mining services group. They announced Dr. Vanessa Torres is taking over as Managing Director and CEO on June 1st, 2026.
Which perfectly reinforces the pattern. Mining services is an incredibly brutal, margin-thin business.
Because they're basically contractors, right?
Yeah, you are managing thousands of contractors, heavy machinery, and complex global teams across multiple jurisdictions. The leadership mandate there leans incredibly hard into technical operating experience, safety, and productivity.
They don't have time for theory.
The market has zero patience for pure strategists right now. They want proven operators.
Okay, I am tracking with you. I get why a sprawling mining conglomerate or an offshore energy giant needs a hard-nosed technical operator who understands complex machinery and decade-long supply chains.
Makes sense.
It does. But this is where the Byron Thomas report throws a curveball.
Oh, the consumer stuff.
Yeah. This demand for what they call operating rhythm isn't just restricted to digging dirt. It is suddenly dominating the consumer world. And I am trying to square that with what we are seeing in fast food.
It seems like a stretch, but it's not.
Let's look at Domino's Pizza Enterprises. They appointed Andrew Gregory as their incoming group CEO, set to start by August 5, 2026.
Right.
I have to be honest, selling $5 pizzas seems completely divorced from the logic of mining iron ore. How on earth does the same hiring mandate apply?
Because structurally, running a massive global fast food franchise is shockingly similar to running a mining logistics network.
Wait, really? A pizza chain?
Yeah. The report makes a really astute observation here. Running a global quick service restaurant, a QSR, is not a brand job. It is a system job.
Okay, let's break down what a system job actually means in this context, because I think people assume a consumer-facing CEO just, approves advertising campaigns and tastes new menu items.
Right. They think it's all about picking the new crust flavor. But running a QSR is like conducting an orchestra where half the instruments are actively on fire.
Wow.
Andrew Gregory isn't being hired to come up with a catchy new jingle. He is inheriting an incredibly delicate ecosystem of interlocking pressures.
Like what?
Well, you have global commodity pricing, the cost of wheat, the cost of cheese, the cost of cardboard.
Right.
You have severe labor shortages impacting physical store operations. You have franchisees who are screaming about their margins being squeezed, while on the other end, you have consumers who are aggressively pulling back their discretionary spending and demanding cheaper products.
Have a massive balancing act.
And on top of all that, you have a massive digital app infrastructure that has to process millions of microtransactions flawlessly.
Because if the digital app crashes during the Super Bowl, or if the supply chain fails to deliver dough to 300 stores in Europe, the entire commercial rhythm dies. You have to take all of that immense friction. Investors wanting growth, franchisees wanting profit, customers wanting discounts, and somehow engineer a system that satisfies all of them simultaneously without the whole thing collapsing.
Which requires intense operational cadence. The Domino's board isn't looking for a charismatic marketer. They are looking for a systems engineer who can balance unit economics at a massive multinational scale.
We are seeing that exact same demand for a system stabilizer in the financial sector too.
Oh, definitely.
Let's look at the ANZ appointment. Nuno Matos commenced as CEO on May 12, 2025, moving over from a major role at HSBC.
And the banking sector is arguably the most complex system of all.
I can imagine.
By bringing in Matos, the ANZ board was explicitly purchasing international banking scale and deep execution discipline. They made this move during a highly volatile cycle marked by fluctuating interest rates, intense mortgage competition, and shifting capital requirements.
And the communication burden on a bank CEO today is just staggering.
It's unbelievable.
The report notes that an executive in that position is increasingly expected to simplify the narrative for regulators who want more capital held in reserve, customers who want lower interest rates, investors who demand higher dividends, and staff who are navigating internal restructuring.
Yeah.
You have to tell 4 different groups exactly what they need to hear without contradicting yourself.
The mechanism driving that is actually simplification through operational excellence.
What do you mean by that?
It's about taking a sprawling, heavily regulated legacy financial institution and making the internal machinery run so smoothly that the underlying complexity becomes entirely invisible.
Invisible to who?
Invisible to the retail customer tapping their phone to buy a coffee and to the regulator auditing the balance sheet. That is the essence of the heavy lifter mandate.
Okay, so we just spent a lot of time talking about boards who look at their massive, complex machines, whether that is an iron ore train, a pizza supply chain, or a retail bank, and say, we need an operator to keep this running perfectly.
Right, the maintenance and optimization of the machine.
But as I read further into this source material, there is a distinctly different, much darker theme emerging. What happens when the machine hasn't just slowed down? What happens when the machine has visibly, spectacularly exploded in front of the public?
Well, then you transition from the mandate of operational rhythm to the mandate of trust repair. And you cannot just throw a standard operational CEO at a trust deficit.
Which brings us to the core realization in the report. Trust repair is not a monolith.
No, it's very specific.
The specific flavor of trust you have lost dictates the specific type of leader you have to hire to fix it. Boards are having to surgically select leaders who can restore forward momentum while operating under the most suffocating public, regulatory, and shareholder scrutiny imaginable.
Because trust exists on a very fragmented spectrum. A company can lose the trust of its retail customers. It can lose the trust of its institutional investors. Or it can lose the trust of the broader market infrastructure itself.
And the hire has to match the fracture.
Perfectly. The executive you place in the CEO chair has to map flawlessly to the exact nature of the fracture.
Let's start with the crisis of market infrastructure and technological trust. The Australian Securities Exchange, the ASX.
A huge example.
They appointed Anthony Attia as managing director and CEO, officially starting September 1st, 2026. But the critical detail here is that Darren Yip is taking over as interim CEO with just 5 days' notice, stepping in on May 29, 2026.
The ASX is the absolute perfect test case for the specific kind of trust deficit. To understand this appointment, we have to look at the massive elephant in the room, which the report highlights, the CSS replacement saga.
Yeah. For those who aren't deeply in the weeds of financial market plumbing, CSS is the clearing and settlement system for the entire Australian stock market.
It's the backbone.
It is the digital ledger that actually proves you own the shares you just bought and ensures the seller gets their money. It is the bedrock of the entire financial ecosystem.
Exactly.
If you replace it and the new system glitches, billions of dollars are left floating in limbo. It is not an IT problem. It is an existential threat to the economy.
Precisely. And the ASX embarked on a highly ambitious, highly publicized project to replace this aging COBOL-based system with a blockchain-inspired distributed ledger technology.
Which sounded great in theory.
Sounded amazing. But after years of development and hundreds of millions of dollars, the project essentially collapsed.
Ouch.
It was a deeply embarrassing, highly public failure that drew immense pressure from the Australian Securities and Investments Commission, ASIC, and the Reserve Bank of Australia.
So market infrastructure leadership in that specific context is no longer just about having a great resume running a traditional exchange.
Not at all.
It is deeply, inextricably tied to forensic technology delivery, ruthless operational risk control, and desperately trying to convince regulators that you actually know what you were doing.
Which perfectly explains the staged handover and the interim appointment.
Right, because 5 days notice is crazy.
It is. But the ASX as an institution has to protect market confidence every single second of the day. They cannot afford a leadership vacuum, not even for a week, when they are under the microscope for a massive technical transformation failure and a severe governance test.
So they needed someone immediately.
Darren Yip, stepping in, immediately signals to the regulators that the shop is being managed, while Anthony Attia prepares to take on the long-term structural rebuild. It highlights the absolute necessity of unbroken continuity during a fragile transition.
Okay, so that is technological infrastructural trust. But let's look at the complete evaporation of consumer brand trust. Look at Optus.
Oh, the Optus outage?
Yeah. They appointed Stephen Rue as CEO back in November 2024. And the context here is vital. Optus went through one of the most catastrophic brand crises in recent Australian corporate history.
It was national news for weeks.
We are talking about a nationwide network outage that literally stopped the country. Small businesses couldn't process EFT POS payments, train networks were halted, and people couldn't call emergency services.
The betrayal felt by the public was visceral.
Truly visceral.
When a brand takes a hit of that magnitude, the damage isn't just to quarterly revenue, it is to the fundamental social license to operate. What is particularly notable about the Stephen Rue appointment, and what the Byron Thomas report zeroes in on, is the structural governance change that accompanied his arrival.
Right. The report mentioned something about his reporting line.
Yeah. Rue was hired under a new model with a much more direct board reporting structure to the parent company, Singtel.
That is a massive detail that usually gets buried in the fine print.
It really is.
It means the board isn't just firing the pilot and bringing in a new one. They are literally re-wiring the instruments in the cockpit so they can see exactly what the pilot is doing.
Exactly. The board realized that in a trust repair mandate of this scale, they cannot sit back and wait for a sanitized 60-page PowerPoint deck at the end of the quarter.
They need to be in the weeds.
They need their hands much closer to the steering wheel. The new governance model ensures a deeply tightened feedback loop between the executive team executing the incredibly delicate recovery and the board overseeing the risk.
And Stephen Rue himself.
Stephen Rue is a seasoned infrastructure and financial leader. He previously ran the NBN. He represents stability, not flash.
Then you have a third variation. Not a broken machine and not an exploded brand, but what we might call trust maintenance after extreme trauma.
Yes, the post-transformation phase.
Virgin Australia.
Huh?
Dave Emerson formally became CEO on March 14, 2025, succeeding Jane Hrdlicka.
This is a textbook example of signaling continuity to a very weary ecosystem. Virgin Australia went through a brutal existential restructuring during and after the pandemic.
Right. They basically had to rebuild the airline.
They went into voluntary administration. They were bought out by private equity. They completely overhauled their fleet and their market positioning. Jane Hrdlicka drove that massive, painful transformation.
But once the surgery is over, you don't necessarily want the surgeon running the physical therapy.
Great analogy.
By choosing an internal, move-elevating Dave Emerson, who is already deeply involved in the commercial side of the business, the board is sending a very specific message.
What's the message?
They are telling the market, the unionized workforce, and the frequent flyers that the wild, unpredictable ride of restructuring is officially over. They are putting commercial execution and customer reliability back at the absolute center of the narrative.
It's about stabilizing the corporate heartbeat.
But this brings me to a massive contradiction that I want your analysis on.
Okay, let's hear it.
If a company, let's take an Optus after the outage, or the ASX after the Shishes failure, desperately needs to rebuild public trust, my instinct says you should bring in the absolute best communicator money can buy.
You're thinking PR.
Yeah. Shouldn't they hire the loudest, most charismatic storyteller? Someone who can go on an apology tour, sit on morning television, spin a grand narrative about redemption, and, make everyone fall in love with the brand again.
It is a totally natural assumption, and it is how a lot of boards used to operate. But the data shows it is a complete myth.
Really?
In fact, in a highly sensitive trust repair environment, hiring a loud, charismatic storyteller is quite literally the most dangerous decision a board could make.
Wait, why? If the public is angry, don't they want to be reassured?
Because the psychology of betrayal changes how humans process information.
Oh, that's interesting.
When a customer or a regulator feels burned, they become hypersensitive to anything that smells like public relations. They don't want a narrative. They despise spin.
So an apology tour actually backfires.
It totally backfires. The Byron Thomas report is explicit about this. In a trust-sensitive appointment, the absolute best executive is the one who can stabilize the system, communicate with almost boring plainness, keep internal teams aligned, and make incremental, visible progress without ever overpromising.
So it is the ultimate expression of underpromise and overdeliver, but executed on a billion-dollar scale.
Exactly. If your car engine explodes on the highway, you don't want the mechanic to come out and sing you a beautiful song about the theoretical future of transportation.
No, I definitely do not.
You want a mechanic who looks at the engine, tells you exactly what is broken in plain English, quietly fixes it, and hands you the keys.
Right.
Trust is not rebuilt through grand, sweeping speeches. It is rebuilt through reliable, repeatable, undeniable operational competence.
Okay. We just talked about rebuilding chess, overhauling a national telecom network, and managing billions of dollars in mining infrastructure. And the reality is the CEO cannot possibly manage that level of operational execution and capital drain alone.
No, they need a partner.
Which leads us to the third major theme of this deep dive. The role sitting right down the hall from the CEO has fundamentally mutated.
The evolution of the chief financial officer. It is arguably the most profound shift in the modern corporate hierarchy.
I'll be totally honest, when I hear CFO, my brain immediately defaults to the old stereotype.
The bean counter.
Yes. The ultimate bean counter. The person sitting in a windowless back office, managing the spreadsheets, saying no to marketing budgets, and just making sure the corporate taxes are filed on time so nobody goes to jail.
That stereotype is entirely dead.
Really?
The report states unequivocally that a technically sound CFO who merely manages the accounting but who cannot actively influence corporate strategy is completely underpowered and obsolete in the 2025 and 2026 market.
Wow.
The financial complexity of the current economic cycle has dragged the CFO out of the back office and planted them firmly in the co-pilot seat.
Let's look at how this plays out in the real world, because the situation in AMP is absolutely fascinating. A&P has been going through a massive multi-year, highly complex rebuild.
A very public one, too.
In March 2026, Blair Vernon stepped up to become the group CEO. But he didn't come from marketing or sales. He stepped up directly from the CFO role.
Right.
And then, a few months later, they appointed Jackie Cleary as the new CFO, starting in July 2026.
If we connect this to the bigger picture, the mechanism driving those appointments is incredibly revealing. A&P is executing a ruthless, capital-focused rebuild.
They're stripping it back.
They are simplifying their portfolio, returning capital to shareholders, and aggressively managing costs. By elevating the person who held the purse strings to the absolute top job and then bringing in a new, high-powered financial mind to stand right beside him, the board is screaming a message to the institutional investors.
What's the message?
They are saying that finance, balance sheet optimization, and capital allocation are no longer just support functions. They are the core strategy.
They're wrapping the entire executive leadership around operating discipline. It is the ultimate proof that the board's confidence is directly tied to financial mechanics.
You see the strategic elevation literally baked into the job titles now. Look at Ian Wells at Aurizon. He commenced his role on April 7, 2026.
I noticed that he isn't just the chief financial officer. His formal title is CFO and Group Executive Strategy.
That blended title tells you everything you need to know.
Because it's not just about the math anymore.
Right. At a massive rail freight operator like Aurizon, where you are dealing with immense capital expenditure on rolling stock and infrastructure, you cannot separate the money from the mission. The finance brief is explicitly tied to long-term portfolio optimization and deciding exactly which parts of the business get funding and which get starved.
We're seeing this new breed of financial leader deployed during massive corporate pivots, too. Look at Aurora. They appointed Paul Victor as CFO, effective November 4, 2026.
That's a great example.
This is a massive post-transaction finance brief.
Yeah.
Aurora had just executed major portfolio surgery, including the massive Saverglass acquisition and the sale of their Aurora Packaging Solutions division in North America.
Paul Victor isn't stepping in just to tally the receipts from those deals. His mandate is deep structural integration.
He has to actually make the deals work.
Exactly. He has to take these massive shifting puzzle pieces, align the debt structures, realize the promised synergies, and make the math actually work for the shareholders over the next 5 years.
And then you have Aaron Bloomer at ResMed, appointed CFO effective May 4, 2026. ResMed is a global healthcare behemoth operating in a massive growth sector.
Right, a totally different dynamic than Aurora or Aurizon.
Yeah, he is being brought in to instill growth company finance discipline. He has to balance rapid global expansion, supply chain realities for medical devices, and intense operational performance.
When you aggregate all these moves, A&P, Aurizon, Aurora, ResMed, a very clear blueprint emerges for what the market actually expects from a modern CFO.
The new criteria.
The Byron Thomas report outlines a series of non-negotiable requirements that go way beyond knowing how to run a reliable month-end close.
Let's break these down not as a checklist, but as a real-world scenario.
Right.
Because if a rising finance executive is listening to this is the exact criteria boards are using to judge you. The first major shift is a relentless focus on capital allocation judgment.
It is the difference between counting chips and placing bets.
Ooh, I like that.
A traditional accountant tells you how much money the company made. A modern CFO looks at a finite pool of capital and decides exactly which division gets funded to generate the highest possible return on investment over the next 3 years and which division gets cut off. It is ruthless prioritization.
And they have to do this while maintaining absolute lender and investor credibility. Because when the macroeconomic waters get choppy, when interest rates are unpredictable, the CEO's grand vision won't calm the markets.
No, it won't.
The institutional investors and the syndicated banks look directly at the CFO. They need to know that the person managing the debt covenants is completely unshakable.
Which is why the report heavily indexes on transformation experience. Every single major company right now is either actively disrupting their own business model or aggressively defending against being disrupted.
There's no middle ground.
The CFO has to know how to finance a massive multi-year technological or operational pivot without bankrupting the core legacy business that is currently paying the bills.
But to do that, they need what the report calls commercial courage. I find this to be the most compelling requirement of all.
It is vital. A modern CFO cannot be a yes man to a powerful CEO.
Right.
Imagine a scenario where a visionary CEO walks into the boardroom, absolutely obsessed with acquiring a flashy AI startup because it will look great in the press.
A vanity project.
Exactly. The CFO must have the backbone to look that CEO in the eye in front of the board and say, the unit economics do not work, we cannot afford this, and it will destroy shareholder value. They are the ultimate counterweight to executive hubris.
And to win that argument, they need absolute data and systems fluency. We are living in an era where data changes by the millisecond.
You can't wait for month-end reports?
Exactly. A modern CFO isn't waiting for a spreadsheet at the end of the month. They are leveraging artificial intelligence to forecast cash flow and model supply chain risks in real time.
And that leads to the hardest balancing act of all, the ability to explain risk without paralyzing the business. A bad CFO sees a risk and immediately says no, grinding the company to a halt. A great CFO sees a risk, quantifies it, and says, here is exactly how we navigate around it.
I love that distinction. It makes me think of an analogy.
Let's hear it.
The old school CFO was essentially a historian. Their entire job was to look backward. Here's how much money we spent last quarter. Here is where we went over budget. Here is the historical record.
Right, logging the past.
But the modern CFO is a navigator. They are sitting in the passenger seat, looking straight through the windshield, reading the real-time telemetry, and telling the CEO, you have a clear stretch of road for the next 3 miles, you can floor it. But there's a massive hairpin turn coming up, and we need to downshift right now.
That is exactly how the dynamic works. But the report includes a vital caveat to that analogy.
What's that?
A strategic CFO who can do all this brilliant high-level navigation, but who somehow neglects the basic governance, if they fail to run a reliable audit, or if they fumble the basic cash forecasting of the historian role, they will be fired instantly.
So you can't just be the ideas person.
No, you cannot just be a strategist. You have to execute the foundational accounting flawlessly while navigating the future.
We have covered immense ground so far. We have seen how geopolitical and economic pressure has forced boards to abandon visionary storytellers in favor of gritty, operational heavy lifters, especially in resources like BHP.
Yeah, that massive shift to execution.
We have unpacked the delicate, plain-spoken mechanics of trust repair at institutions like the ASX and Optus. And we have explored how the CFO mutated from a back-office historian into a commercially courageous navigator.
It's a totally different landscape now.
But let's bring all this theoretical analysis down to the ground floor. Let's look at the playbook. What does this mean for the listener? How does this fundamentally change the way boards must operate and, the way ambitious candidates must interview?
Well, the practical immediate lesson for boards of directors is that they can no longer afford to be vague. The cardinal rule of executive hiring in 2026 is that you must ruthlessly define the problem before you ever attempt to define the person.
So if a board sits in a room and says, we just need a dynamic, forward-thinking leader to take us to the next level, they have already failed.
Completely, because a mandate that broad means the executive search firm will just bring them a parade of shiny resumes, and they will hire someone based on an impressive past rather than a specific future fit.
They'll hire the TID Talk guy again.
Exactly. The board has to sit down and confront brutal reality. Are we trying to maintain continuity after a crisis? Do we need a total cultural reset? Are we actively bleeding cash and need a turnaround specialist?
Right.
Are we trying to integrate a massive acquisition? Every single one of those scenarios requires a completely different human being with a completely different psychological profile and skill set.
The report structures this around a framework of specific questions a board must answer before they even dial the phone to a recruiter.
They have 5 questions, yeah.
And it starts with identifying the existential threat. A board has to clearly articulate the specific business risk this new appointment is meant to reduce, because you have to know exactly what you are afraid of before you hire someone to protect you from it.
Once you identify that fear, you have to determine what actual hard evidence would prove a candidate can neutralize that risk, not what they claim in a cover letter, but what forensic proof they can offer.
And then there is the stakeholder angle. A board has to map out exactly who needs to trust this new executive from day one.
This is so crucial.
Because if you hire an amazing operational CEO, but the labor unions despise them and the regulators don't trust them, the operation will fail anyway.
Furthermore, the board has to look at the existing C-suite. No leader operates in a vacuum.
You mean checking for team gaps?
Yes. If the board realizes they absolutely must hire a visionary CEO to pivot the company's product line, they have to simultaneously look at their CFO and COO and ensure they have ironclad operational stabilizers surrounding that visionary.
The final piece for the board is confronting trade-offs. The report demands boards establish exactly what sacrifices they are willing to accept.
Right, because there's always a cost.
If you hire a technical transformation expert to rebuild your legacy software, are you willing to accept a hit to your short-term profit margins while they spend the necessary capital? If a board hasn't agreed on that before the hire, the new CEO will be fired in 12 months when the profits dip.
So that is the maturity test for the board, but the reality check for the candidate is equally brutal.
Let's talk about the candidates.
If you are an executive aiming for a C-suite role today, your old interview playbook, the one where you walk in, smile confidently, and talk about your leadership philosophy, is entirely obsolete.
You cannot just walk into a boardroom and say, I am a proven leader who builds high-performing teams and drives transformation.
No, those are hollow buzzwords to a modern board. They want the agonizing, granular details.
What do you mean by granular?
They want forensic proof of outcomes. Let's say you were interviewing for a CEO role. The board expects you to explain exactly how you navigated capital allocation during internal turf wars.
Oh, wow.
Yeah. When 3 different divisional heads came to you demanding the same pool of money for their projects, how did you analyze the returns? Who did you defund? And how did you manage the political blowback of that decision?
They want to see the scars of your commercial courage.
That's a great way to put it.
They will ask you to detail exactly how you dealt with a severely underperforming asset. Did you spend 2 years trying to fix something that was broken? Or did you make the ruthless decision to fire the team or sell off a beloved but unprofitable division?
And they will probe your ability to speak the language of capital. Can you explain a complex, messy operational reality in a way that pacifies a room full of nervous syndicated lenders and institutional investors?
And there is one specific interview question highlighted in the report that I think is absolutely devastating in its effectiveness. Boards are now asking candidates, what did you stop doing?
That is a brilliant diagnostic tool.
Why is that so effective?
Anyone can launch a new, flashy initiative to look busy and generate press releases, but a true operational leader, a heavy lifter, knows that strategy is largely about deciding what not to do.
Right.
If a candidate cannot point to a legacy project they killed or a redundant process they eliminated to improve the overall operational rhythm, they are not the systems stabilizer the board is looking for.
It all distills down to the core philosophy driving this entire wave of appointments. The market reality of 2025 and 2026 is that a board of directors is not buying your past. They are buying a probabilistic guarantee of your future performance in their specific messy system.
Yes.
If you are an external candidate trying to win a job at a company like ANZ or Domino's, the burden of proof is entirely on you. You have to translate your past experience into their specific operating language, and you have to prove the outcome before you ever sign the contract.
The tolerance for error, the tolerance for learning on the job is virtually zero.
We have taken a massive journey through the corporate landscape today. We started by examining the shift away from visionaries toward deep, gritty, operational execution, highlighted by the elevation of leaders like Brandon Craig at the heavy industry titan BHP.
It's a totally new era.
We unpack the nuanced psychology of trust repair, realizing that fixing a broken institution like the ASX or a battered brand like Optus requires plain-spoken, boring competence rather than charismatic storytelling.
Boring is the new brilliant.
We tracked the incredible evolution of the CFO from a back-office historian into a commercially courageous strategic navigator. And we break down the unforgiving new playbook for both the boards who are defining these mandates and the candidates who must provide forensic proof of their outcomes.
It is a fundamentally reshaped corporate environment, driven entirely by the demand for systemic reliability.
So as we wrap up this deep dive, I want to bring it back to you, the listener. Why does all of this matter when you close this app and go back to your day?
Because it really does impact everyone.
Whether you are aggressively maneuvering for a spot in the C-suite yourself, whether you are trying to hire the right manager for your own department, or whether you are simply an investor trying to read the tea leaves of the stock market, you have to look past the sanitized press releases.
Look at the actual hires.
Yes. Looking at the why behind executive hires is the truest X-ray we have into the health, the hidden anxieties, and the future trajectory of a company.
And that actually brings me to a final thought I want to leave you with, something to mull over that builds on everything we have explored today.
Go ahead.
We have seen crystal clear evidence that boards in 2025 and 2026 are aggressively, surgically hiring to fix the massive problems they are staring at right now. They are finding the absolute perfect person to manage strict capital control or the exact right person to rebuild trust after a specific technological crisis. But here is the massive inherent danger in that level of precision. By hyper-focusing on candidates uniquely and perfectly suited to solve today's visible crises, are these boards accidentally creating a massive blind spot for the unseen, completely unpredictable disruptions of tomorrow?
Oh, wow. That is a fascinating and slightly terrifying question to end on because you perfectly optimize your entire leadership team to fight the current war. What happens when peace breaks out or when a completely different kind of war unexpectedly starts?
Exactly.
The corporate X-ray might show you exactly what is broken right now, but it cannot show you what is going to hit you tomorrow. Thank you so much for joining us on this deep dive. It has been an absolute pleasure unpacking this complex landscape with you. Until next time, keep looking past the surface.